evening, everybody. Luke Gromen, FFTT. Hope everybody's well and had a great weekend. I'm going to jump right in here to the two things that grabbed our attention recently. The first is the Fed again extended their temporary repo program. Originally, if you remember, we had the repo spike 3 weeks ago. Tomorrow, repo rate spike. The Fed addressed it with overnight repos. Originally, it was just going to be one overnight repo. Then it was two. Then it was three. Then it was some standing repo facilities, or some term repo facilities, excuse me, that would stretch out a couple weeks. Then they extended the repo facilities they would provide to the markets in terms of liquidity to October 10th, which was, well, to give them some, past the quarter end, because it was supposedly technical temporary issues associated with quarter end. Last week, or late on Friday, they noted they would extend this now to November 4th, which is, of course, a full month past quarter end, and to us, hints at something we've been saying all along, that it's neither temporary nor technical, but rather a more acute symptom of the worsening dollar shortage within the U.S.'s own banking system. So that's the first thing that grabbed our attention. Second thing that grabbed our attention recently was Fed Vice Chair Clarida saying that we will certainly be discussing a standing repo facility among the things we talk about at the upcoming Fed meeting. He said this Friday, standing repo facility is effectively would just make permanent, the repo facilities we discussed. We tweeted something last week, half tongue-in-cheek, but more serious than not, which was, translation, we will certainly be discussing granting ourselves a magic wand we can use to convert treasuries on bank balance sheets into cash with a wave of the wand, effectively allowing us to finance U.S. government deficits through the banking system in perpetuity. And that, I think, is the important thing to take from that, because that's really what a standing repo facility would effectively do. Of course, subject to terms and size, and that's something, if they do announce it, that we'll be watching for and reading others' takes on it as well. But ultimately, standing repo facility would allow, the issue is balance sheet capacity with primary dealers. They're financing treasury holdings, treasury purchases at auctions through repo. So when you're injecting repo liquidity, you're helping the financing of those treasury purchases. And so standing repo facility would basically allow, because of regulatory reasons, cash and treasuries are not equal. It's a regulatory technicality, but it's a regulatory technicality that would be done away with under a standing repo facility for all intents and purposes. So that is another way to supply dollar liquidity to the U.S.'s own banking system to address the worsening dollar shortage in the U.S.'s own banking system, being driven by a number of balance sheet constraint factors into too big a U.S. Treasury issuance and not enough foreign demand for those treasuries. So we're going to jump into a few questions here. Thoughts on Wells Fargo preferred 5% dividends shares trading about par now? It's from 1B. You know what? I hadn't looked at that, and I think it's a really important or interesting question. Just in terms of background, historically, in an environment where rates are as low as they are, if you see a high quality franchise with a dividend trading well above sort of risk-free rates like this ostensibly is, it is a potential flag for of a warning sign that the market sees something going on there that maybe others, just to the casual observer, doesn't. I'm not saying that's the case here, and I don't know the answer to this question, other than to say I think it's a really interesting observation and a good question. So sorry I don't have a better answer than that, but like I said, I do think it's a really good question. From Jared, thoughts on this development? An article noting that China has pulled out of a deal that they had to develop an Iranian gas field. I did notice that this weekend, and it is a potentially important development and a non sequitur in terms of a lot of the other developments we've seen. And so is it because China has a dollar shortage? Is it because some other political reason? Is it simply not true? I'm watching very carefully because, like I said, this does not seem to fit with the recent pattern of facts, and those are the types of data points that typically catch our attention, regardless of whether they match with where we think the world or not, and this where the world's going or not. So this does not match with that view, and so it is it is very interesting to us, something we'll be watching and following up on. Let's see, can we please explain the significance of Fed funds over IOER from FC? Yeah, so Fed funds is an interbank lending rate. Fed funds being above IOER means that there is basically a risk-free arbitrage banks can pick up for free by lending excess reserves into the Fed funds market, and all they have to do is do so. In theory, there is no risk because it's interbank or very little risk. It's basically, banks are walking over a free $20 bill laying on the sidewalk. And so the question is, why aren't they picking it up? Some believe that, the banks believe the $20 bill is sort of rigged to a mine. Our view is that they don't, the excess, what is defined as excess reserves are not actually excess, that there's actually a shortage of dollars in the U.S.'s own banking system that are being sucked up by the requirement of big primary dealers to finance U.S. government deficits, to make sure U.S. Treasury auctions don't fail. So that's the significance of that. It suggests it's basically a pressure gauge on the dollar liquidity within the U.S.'s own banking system. Let's see. Why does QE cause assets to go higher? I understand it's necessary to keep rates low in the bond market, but how is this different than our current low rate environment? For us, the reason that is I think partially psychological, but I also think, again, if they are being forced to increase the amounts of their balance sheet to keep rates steady, it tells you that money supplies are going to have to grow. This is sort of something we've been talking about for the past 6+ months, which has been the Fed's going to be forced to make a choice. Do they want to control the price of money in the U.S. And cede control over the quantity of money, or do they want to cede control over the price of money or rates to control the quantity of money? And push came to shove 3 weeks ago, and this repo program, this temporary overnight repo program and term repo program, and now it's extended until November 4th, is them ceding control over the quantity of money to control rates, to control the price of money. So ultimately, that's more money coming into the system, or the promise of more money coming into the system, again, because the pressures that cause this repo spike are not temporary. Yes, the acuteness of them maybe were a little bit more acute at quarter end, but ultimately deficits aren't going away. So these pressures are going to continue to mount slowly and intensify at quarter ends, but intensify secularly until the dollar falls to normalize the FX hedging costs of foreigners buying treasuries. So I am going to jump at this point. As always, check out FFTT-LLC.com for updates on what we're up to and information on how you can sign up for Tree Rings, which is a weekly piece, top 10 most interesting things list and synopsis that we are doing that is proving incredibly popular. So if you like these quick updates, I assure you that, or at least it's highly likely, that you'll like Tree Rings. So at any rate, everybody have a great week and look forward to catching up with you guys soon. Take care, everybody.